You ever dream at night wondering to yourself, how do stocks move? So you open your phone, type in ChatGPT, and fast forward at 6 a.m., the sun's up, the kids are awake, and you still can answer the question, how do stocks move? According to social media, the stock market was coded by a guy who created a Twitter account in 2022. What if I told you this price has been written about since the early 1900s by people who created some of the most famous financial instruments in the world? Have you ever heard the news talk about the Dow? Look, here's the problem. When you start trading, you think more complexity equals more profits, but that's just wrong. You can draw all those fancy zones trying to spot institutional order flow, discount zones, or order block displacement, or you can understand how price actually works. Nothing in the stock market is new, just rebranded. What really turned my trading around was keeping things simple. In this video, I'll show you the patterns that make me money. No BS, no complex terminology, just straightforward setups that work in real markets. And I bet you'll be able to give a better answer than 90% of retail traders to my question, how do stocks actually move? This is the Chaching theory on how stocks move. So what is the origin of Chaching? So it's really simple. So you ever hear the cash register open here, Chaching? Or you ever get like a payment, right, and hear Chaching? Or you ever get a Venmo and hear Chaching, right? So that's all it is, okay? So origin of Chaching theory. So why do we care about the origin of Chaching theory? Now, I've been posting Chachings pretty much all year. It's kind of my new catchphrase. So when someone tags me on a cool trade on Twitter, I write Chaching, right? By the way, guys, if you ever hit a cool trade using any of my strategies, tag me on Twitter. I love retweeting things, right? When I post an alert and it hits low a day, Chaching, 130%, you get the idea. Chaching, 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 right? So it's really just a catchphrase or a celebration when you make a bunch of money because a cash register is throwing money at you. So let me propose a question. How many times have you seen this? Okay, a stock just goes up and up and up and up, or down and down and down and down, or up and up and up and up, right? Have you seen this? And you're probably thinking to yourself, like, how do I capture these big moves? Right? Like, look at lunch. If you bought calls here, you made money. All of these candles. If you bought puts right here, you made all this money. And here, if you bought calls, you just made money, 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 right? Cha-ching, cha-ching, cha-ching. Okay? The key here for all these questions, okay, the key to understanding how to capture these big moves is looking left. Every stock has a story. What happened in the past? Was the stock bullish in the past? Was it bearish in the past? Was it a once loved stock of the century? Okay, like Nvidia, right? Everyone loved Nvidia. Everyone made a bunch of money on Nvidia, but now Nvidia is no longer the most handsome darling of the bunch. What led to these events, right? Why did Nvidia not be as cool anymore? Well, maybe it went up 1,000% and investors are taking profits. Every stock has a story. What happened in the past? Did people make a lot of money on this stock in the past? Okay, do people like buying it? Does the vision make sense? Does the company's story make sense? A recent example is MSTR. People love MSTR because Bitcoin's been so bullish. But what happens when Bitcoin is no longer bullish? What led to these events? Okay, what led to Bitcoin going up and to the right? Was it the NASDAQ? Was it people getting more involved in technology? What led to the events? Why does the stock act this way? Why does a stock move a certain way? We really need to understand that. What is the personality of the stock? Is it a big mover? Does it have a ton of ATR? Does it like to move a lot? Does it do nothing for months at a time and then have big breakouts? We need to understand all of this. Similar to you, okay, everyone has a story. And maybe I'll tell you my story soon, but for now, let's get into the charts. So here's a little history about charts. So Richard Dow, okay, the man who created Dow theory, okay, you ever hear the Dow Jones? Okay, Richard Dow was one of those people. He wrote a book in the late 19th and 20th century, okay, about the Dow theory. Then in 1932, something came out called Technical Analysis and Stock Market Profits. This was published in 1932 by Richard S. Here it is over here. Okay, this book was considered the Bible of technical analysis. Okay, this is when technical analysis became a thing. This was over 100 years ago. This then inspired the writings of Technical Analysis of Stock Trends by Robert Edwards and John M. in 1948. Okay, this is similar to when your parents were born or maybe later. Okay, so this has been a theory and been talked about for almost 100 years. Then in the 80s and 90s, technical analysis became more popular. But what caused technical analysis to become mainstream? So back in the day, all you really had to look forward to was earning reports. Okay, if a stock reported good earnings, the stock would keep going up and to the right. But why? Right? Why did earnings play such a big role back then? Now, things are more focused on technical analysis, and I'll explain to you why. algos and computers. 70% of all trading volume is comprised of algos, okay? When the retail trader is trading, we are trying to beat the algorithms, okay? You, as a retail trader, are executing trades from your phone. What is your phone? It is a computer. If you're trading from a laptop, it is a computer, okay? Everything is done by computers nowadays, okay? So therefore, 70% of all trading volume is comprised of algos, okay? So these hedge funds are running different algorithms that track and trade and do all this kind of crazy stuff. Us retail, we don't really have algorithms, okay? But just know that 70% of all trading algorithm is done by algos, meaning that there is a computer buying and selling behind the screens. So, knowing that, we need to think like an algo, okay? We need to trade like an algo. Algos don't have what? Emotions or fear or anything like that. They're just doing what they're told. So, based on the idea that we need to think like an algo, let's ask ourselves a question. Do algos care about the following intraday? Do algos care about the PE ratio? Not really, okay? The PE ratio means nothing when we're buying 0 days. When the contracts we buy are going to be worthless by 4 p.m. every day, we do not care about the PE ratio day to day. We are day traders. We are not fundamental investors. Do the algos care about cash on the balance sheet at quarter end? Okay, if quarter end just ended, then maybe, because earnings is coming up. But if the cash goes from 100 million, okay, to 99 million intraday, will anyone know? No, because the financial results are sent at the end of the quarter. Do algorithms care about how many chips were sold on a Monday? Okay, if we are buying a grocery store stock, do we care that on Taco Tuesday sales are down? No. Do we care how many iPhones were sold over the weekend or Galaxy phones over the weekend? No. It means nothing when we're trading options intraday. We are day traders. Now, if a headline comes out that's bullish, okay, say we sold 8 billion iPhones in one day, then maybe it could affect the price. But do we care if we sold 10 phones versus 9 phones? The answer is no. Do we also care about the shareholder equity on Tuesdays? No. Most of you don't even know how to calculate stockholder equity or shareholder equity. It means nothing when you are a day trader. All of this is just noise. Based on that, stocks can only do 2 things. They're either resting or they're running, okay? Tell me another thing a stock will do other than doing nothing or doing something. You can't, because stocks can only rest and they can only run. Knowing that theory, this is the basics of price. All of price is based off of the idea that stocks are either resting or running. So, in a really simplistic version, we have a stock here, okay? It's consolidating in this zone, okay? Think of this as the bed. That is why there's a lady sleeping here. She has her head on a pillow. She's getting her beauty rest. Then the stock gets excited and it breaks to the upside and is running, and breaks to the downside and it is running. This is the difference. So in here, in this zone, in this purple box, we are resting. Outside of this, we are running. Remember, stocks can only do 2 things. They're either resting or they're running. There's nothing else they can do. But now let's add another layer of complexity. If I drew this big green line here, you would say, Elliot, that's a bull flag. Okay, so we have this huge move up. Now the stock is taking its beauty rest because it's tired, right? Got all glammed up in the morning, and now it is ready to break out again. But what happens if it breaks to the downside? Let's add another level of complexity to this. This is a bear flag now. If the stock made a huge move to the downside and is now resting, is it going to continue to the downside? All I did was add a line, and now your bias started to change. Remember, I said the key is to always look left. Based on those charts I showed you at the beginning of this video, here is the left. We can see price is doing what? It's resting here. Okay, this is what we call resting price action, or as I call the Gucci snake. And then it broke to the downside, producing a run or a big trend leg. Here's another chart. It's resting in here. See, it's just resting. It's resting its head right before it makes a huge breakout. Remember, stocks can only do 2 things. They're either resting or breaking down. They're either resting or breaking out. That is it. Once you understand that's how price forms, the rest becomes a lot easier. Have you ever seen a picture like this? This is a cheat sheet. Some of you may have this on your monitors or at your desk or at your mouse pad. You probably have something like this with all the different patterns in the stock market. What if I told you this cheat sheet is pretty much useless? Why? Why is it useless? Because they all have one commonality. They all have an area of rest. We can see this stock here, it's resting. Okay, it's resting in the zone, resting in this zone, resting in this zone. You see how when a stock is resting, look, resting, resting, resting. I'm not going to draw squigglies on all of this because hopefully you get the idea. All of these patterns are based off one theory. Stocks are either running or they're resting. Okay, so please remember that. You can learn any complicated price action theory you want, but you have to understand, you can be really good. Say you're really good at trading rising wedge breakdowns or breakouts. It doesn't matter. All you're doing is you're spotting a stock, consolidating, and you're waiting for it to break out, whether it's up or down. So take all these patterns and toss them into the trash. Don't even get me started about this, okay? So here we go. We have a couple fair value gaps with bullish displacement and all these different zones and all that. Look, the stock was resting here, okay, and it broke out to the top side. That is it. You don't need to know these complicated theories and have all these crazy zones on your charts. It will not help you make money. If anything, it will actually give you analysis paralysis, which doesn't lead to profits. So this is where the Chaching theory comes in. Okay, so Chaching theory, remember, think of the cash register. Chaching, right? Price forms an area of rest, or you can call it consolidation. We react when the run is confirmed or the breakout is confirmed. We, as option traders, cannot trade the rest. Why can we not trade the rest? Let's think about it. Let's think to the Greeks of options. I haven't done a video on the Greeks because I find them to be extremely noisy, but let's just think of the Greek that everyone knows. And no, I'm not talking about the coolest frat at your local college. The theory, okay, with the Greek is the theta. Okay, so if you're trading 0 days and the stock market does absolutely nothing, you could be right, but your timing is wrong. So therefore, we do not trade rest, we do not trade chop, we do not trade consolidation. We, as option traders, trade when there is a breakout. Now, one day I'll make a video about how I find stocks to trade. Okay, SPY is comprised of 500 stocks. Okay, if 1% of 500 is trending, I'm going to tell you right now, there's 5 breakout stocks that you can trade to make money every single day. Now, the breakout tells us the direction. The breakout tells us the trend. We don't have to guess or predict which way it's going to go off some magical candle sheet you have stapled to your monitor. Okay, we don't have to do that. Okay, the breakout will tell us whether it's going to go up or down. All we have to do is spot the consolidation, wait for the breakout to go, and then we enter our position. Okay, then this is where we make money. So we make money on the energy release. Okay, the energy release, the breakout, I call it the compression and the spring just being let go, and all the money slaps you in the face, and this causes your account to do what? Cha-ching. So why Chaching theory works? So there's this theory, okay, which is not theory, but I'm going to tell you a story and you tell me if it's theory or not. Stocks absorb all real-time information. Okay, so all the information that comes out, stocks will absorb it, whether it's bullish or bearish. The other day, Google actually released a headline about how their competitor was making a new search with AI. This caused Google to go down in real time very, very quickly. So some people say that that's not true and the stock's not being repriced. That's just wrong. Price isn't random. Okay, price forms over time. It's not random. It's very intentional. Recently, when we had the sell-off in the tariff news, it was very slow and controlled. It was not panic. Okay, there was not panic across the markets. There wasn't markets in turmoil on CNN. It was very slow and controlled. Therefore, price is not random. Algos. Remember we talked about 70% of the trading volume is done by algos. They scan for patterns. Okay, they're looking for that tight consolidation. I don't know if you know this, but if you open up Webull, you can literally search for stocks that are flagging. You can literally search for all of these patterns very, very simply with the click of a button. Let me know. I'll make a video on that as well. And lastly, and most importantly, is candlesticks. Why do candlesticks matter? Candlesticks, I want you to think of them as little people. Okay, and these little people have emotions. They move up and down. Okay, so each candlestick represents human emotions. You You want to always keep that in the back of your head. Think of them as little people. It makes trading less lonely. That's a joke. Trading super fun and not lonely. So let's get into some trades and break this down further. So we can see we have a stock here, okay? It's consolidating. So we have our little wedge here, and we can see it is doing what? It's resting in this zone. We, as option traders, do not trade rest, okay? We just wait for the confirmation. So what are we looking for here? We're looking for either a breakout to fill this gap and then go up even higher, or a breakdown to continue this wedge breakdown, okay? Looking at this, you cannot tell me it's a bullish ascending triangle. You honestly have no idea, okay? That's why all those patterns are basically useless and you take them to the trash, okay? All we know is the stock is resting, and once it's done resting, we're gonna look for a breakout up or a breakout down. That is it. And what happens? The stock actually breaks out, filling the gap, and continues higher. It even retests this to the penny and then continues higher. This is how you make money swing trading. This is actually a daily chart on the ticker Citibank. So you can go and look at this and see how it played out. This was a huge swing. So here's another example. We have a stock made a big trend leg down and now is resting. Okay, we can see it's resting in here. So if you looked at that chart pattern, you'd be like, Ellie, this is a bear flag, okay? It's a bear flag. That means I'm going to buy a bunch of puts, and it's going to go down. Now, I want to caution you, based on Chaching theory, all we know is it's forming an area of rest. So if it breaks above, we're going to buy calls. If it breaks below, we're going to buy puts. And congratulations, your bear flag just got you bagged. And you can see, I took this exact trade and I posted on my Twitter and I made $2,200 in the total trade. Okay, what did I do? I waited for the consolidation. It broke the highs of the consolidation. And once it confirmed the highs of the consolidation, I took it long for well over $2,242.76. This is more than most people's paycheck. And all I did is follow the Chaching theory. Let's look at another example. So here we have a stock. Is it a bear flag? Okay, remember, a bear flag based on that pattern sheet should break down to the lows. However, based on Chaching theory, all we want to do is wait for it to consolidate, wait for it to break the highs of the consolidation or the highs of the rest, or break the lows. Because we know that if it breaks the highs, the stock is going to run. If it breaks the lows, we know the stock is going to run. And what happened? The stock broke the lows and ran to the downside, netting over 195% in gains. But Ellie, what about fakeouts? This is a comment I get all the time on my videos is, what about fakeouts? What about fakeouts? What about fakeouts? And here's the deal, right? Fakeouts don't happen as often as you think. Fakeouts, okay, are what we call failed breakouts. The problem is a new trader gets wicked out, they think it's a short and they take it short, but in reality, it's just a long. Here's an example of a failed breakout, and this is something that I'm going to teach you real quick on how to avoid and just some general pointers. However, if you're an experienced trader, you can use this to make a ton of money. So I made 103% here, and I'll just explain to you kind of thought process behind it. We have a bull flag here, a bull flag. So ideally in a bull flag situation is you want this to push, flag higher, and continue up and up to the right. However, this stock did not do this. A retail trader will come in here, they'll hear me talking about a stock, and they'll buy the high a day right here. So I'm just gonna put high a day. That's a terrible H, whatever. They come in here, they answer calls here, they get stopped out, and they go, Ellie, it's a failed breakout. No, it's not a failed breakout. You just bought the absolute top on the stock because you have FOMO. But here's the thing. The stock comes back down and almost retests this little flag over here, retest. But it doesn't make a new high. Okay, look, it comes down to the zone, tries to break out again, it doesn't. Tries to break out again, it doesn't. Tries to break out again, it doesn't. Doesn't, and then finally breaks the lows. Once it breaks this lows, then it becomes a short, then it becomes a failed breakout. You want to avoid trades like this. And I'm going to give you a couple pointers of some things you can just look for that I think will save you a ton of money, and you'll avoid 99% of fake outs. Because failed breakouts really only happen under certain criteria, which I'm going to cover. So here we go. How to avoid fake outs. Number one is overextended daily charts. If a stock is 3 days green or red in a row, do not trade it. I'm telling you, all the time when I catch crazy reversals on SPY and QQQ, it's after 3 days of green. It's right around that lunchtime. You think it's a bull flag, and it's not a bull flag. You just got bagged. or you thought it was a bear flag. Nope, it was a reversal. This usually happens on day 3 of green. So if you see a stock that's 3, 4, 5 days green in a row, you're better off just waiting for it to have a couple of red days or just some sort of consolidation to then re-enter. This is, I don't know why this works. I call it the rule of threes. I've been teaching it for well over 6 years. It's one of my favorite theories and it's super fun to trade, but yeah, just avoid days that are 3 days green. Example, okay? If this is, let's say, a stock chart, okay, and here's the daily 80 EMA, okay, and your candle is all the way up here, and you have like a $20 gap, okay, to the EMA or a $20 extension, you know, it's just a better idea to avoid it because there's going to be people hunting for reversals and they have way more money and they're way smarter than you and I. So we're just going to let it go and we'll come back to it another day. Next, daily range slowdown. So what does that mean? It means that the candles are getting tighter and tighter and tighter. So say Monday, the stock moved $20, Tuesday, $10, Wednesday, $3. When that range starts to tighten, you really want to start to avoid that because that means it's getting toppy, and then you don't want to get bagged on the backside. Same thing on the downside, right? It starts to curl and daily. You just don't want to get involved. Also, when the range gets super small, you have a high chop risk, and then you really run into a bad time. Next, overall sector weakness and strength. Okay, you do not want to be long all the crypto names when Bitcoin is getting destroyed. You do not want to be long all the tech names when say Nvidia and all the chips are getting destroyed. So you just want to kind of avoid any sort of weakness across a sector. I'm telling you, I see it all the time. A SPY will be just blood red, like getting sent to the gulag, and people are like, I bought Apple calls, why am I not making money? Just don't, okay? Avoid these fake outs, avoid these. Lastly, and most importantly, if you haven't watched my time frame video, make sure to go check it out. Higher time frames must align with all other time frames, okay? If you are trading let's say a 2-minute chart and the 10-minute is bearish, but the 2-minute is bullish, 90% of the time, you're gonna get faked out, it's gonna reverse on you, and you're just gonna have a bad time. So here we go. Here is the hood daily chart. We can see consolidation zone. Remember, stocks are either doing what? They're either resting, okay, or running. Resting, okay, or running. That's all stocks can do. So we can see here on hood, 1 day, 2 day, 3 days. So on this 3rd day, we can see the daily range is getting smaller, day 3 of green, it's extended from the retest spot. Okay, so that's how we know a reversal is going to come, and that is how we made 100 and whatever percent on the trade. So if you can avoid that, you're likely not going to get faked out, you're not going to worry about it, but something to pay attention to. In conclusion, it's really simple. We only enter stocks that are running. Remember, stocks can only do 2 things, either resting or running. So if a stock is running, we're going to trade it, it's going to have trend, we're going to make a ton of money. We always focus on the big picture of a trend. If a stock is down at the 52 weeks lows and will never stop selling, okay, we don't want to get involved for a bounce. We want to buy stocks at all-time highs that are just ripping to the moon. They don't care about the news. The market gets bearish, they get mad on dips. Those are the stocks we want to be long. Same with the stocks that are weak. If a stock just keeps selling, don't stay long on it. Same thing if a stock is selling. If it's selling and going down and to the right, you do not want to find out the reason why it's selling. You just want to get out, cut your loss, and go buy something sitting at all-time highs. We want to trade like an algo. Algos don't have emotions. All algorithms do is spot areas of tight consolidation, wait for the run, they enter it, and they make money. That is it. They don't have emotions. They don't really care what the news says. They don't really care about what the news makes them feel. They do not have any emotions. And lastly, fake outs happen, okay? I get faked out every now and then. It's pretty rare. Normally I'm actually on the right side, but all you can do is manage risk and avoid these high risk setups. Okay, it means you're going to stop out, you're not going to get tilted, and if you see a stock that's just been on an absolute tear, say Monday through Wednesday, on Thursday, maybe just avoid it. Make it one of your rules that if it's 4 days green, you're just going to avoid it. This will help you manage your risk, avoid those high risk setups, and you won't get faked out. I hope you enjoyed. This is how the Chaching theory will make you rich.